Hello everyone. This is a review of some exercises using deferred taxes. Given information with regard to both the tax return and the income statement and working on them side by side. So there's a couple different ways we can look at those differences, and this is one way, and that is to basically start where they are having common and then make any changes based on the differences. So that means that we're going to have two columns, the tax return as it looks and the income statement as it looks. So according to exercise 1, we're going to have 243,000 at this starting point when things are the same. That includes this permanent difference. So this $20,000 of municipal bond interest needs to be subtracted before we put the income on the tax return. So that's what we're doing here. It does not need to change on the income statement because it's supposed to be on the income statement. So we make the change here. That's a permanent difference. Changes just one side. It's not going to affect any other year, just this one year. All right. Then there were a couple of items that had not been considered on either the income statement or the tax return that are going to be different. So for bad debts, we estimate on the income statement and we take the write-offs on the tax return. So since we're doing two columns and we're going to track them separately, we'll take the actual write-offs as bad debts and the income statement, we'll take the estimate. All right. Depreciation, we bought a new asset and that asset qualifies under bonus depreciation. So that bonus depreciation is the amount, 50% of the original amount of we bought. 61,500 divided by 2 is 50%. The rest of the asset, the other half, is depreciated using makers, and you can find makers tables anywhere just by doing a Google search, makers tables for 7-year property. And in the first year, you multiply the cost by 0.1429. A little quick review on calculating depreciation for tax purposes there. So the total depreciation on the tax return would be the sum of those, okay? Subtracted, obviously, to make our taxable income lower. That's why this is a negative, okay? On the income statement, we just do straight line, nice, easy. We just take the total cost divided by 7, and I told you you would use a half-year convention, so you take half of that. In the year that you purchase it, you just take half a year, so you get the 4393. All right. So your taxable income, as shown on your income on the tax return, would be 184,356. On the income statement, your income before taxes would be 226,607. Now to make your journal entries, all right, you take your taxable income times your tax rate and get your current tax expense and your credit tax payable. You get, then look at the various differences, temporary differences. No journal entry for a permanent difference, only for temporary differences. And if you look at what you're now looking at is the difference, the cumulative difference. Well, it's only been 1 year because this is the first year of operations. So the difference between bad debts for income statement and a tax return is $8,500. That's the difference there. That's the cumulative difference in this case as well because it's only 1 year. We multiply that by the tax rate and we get $29.75. Now, is that a deferred tax asset or a deferred tax liability? Well, those bad debts are going to be future deductible amounts. This estimate, eventually, those people will not pay us if our estimate is correct, and then we will write them off. So that's a future deductible amount. Future time we will deduct that against our income on the tax return. So that makes it a tax asset, credit tax expense. So anytime you make an asset go up, you make the expense go down. If you make an asset go down, you make the tax expense go up. And just the opposite for liabilities. So looking at liability, we're looking at depreciation. Again, the difference, since it's only been 1 year, the difference between the 2 years is $30,751. Take that, multiply by the tax rate, you get $10,763. That's a deferred tax liability because you're going to have to pay more taxes in the future because of this extra depreciation you took now on the tax return. So because this was a deduction now, later your income is going to be higher and you have to pay more taxes. So you record a liability for that and we debit the tax expense. So your current tax expense is the 64. Your deferred is the sum of your journal entries to tax expense. Boom, boom. Okay, in this case, it's not a sum, it's a difference because one is a credit, the other is a debit. So the difference between those two is $77.88. So your total tax expense is $72,313, which goes on the income statement. Calculate your net income. So if we do a quick rate reconciliation, we get our 72 divided by the income before taxes. That's an effective rate of 32%. Municipal interest was $7,000 difference because that's $20,000 of our interest times 35% or 3%. Add those together and you get the statutory rate. So the GAAP requires us to show our effective rate, the statutory rate, and anything that makes it explains the difference. And those are always permanent differences. And any significant ones need to be listed. So municipal interest, significant, listed there, shows how you calculate it. Okay. Moving to the next year, some of the same things, starting with some point that where things are in common, but the interest and life insurance were included here. So we need to take it out to put it on the tax return. So when we go to put it on the tax return, we take those items out. Municipal interest, we pull out. Life insurance, we add back because that would have been an expense that we're going to add back. And then we do the bad debts the same way. This is the write-offs. This is the estimate, just like it shows here in our T account for the allowance. We have a new item, unearned revenue, that came in during 2016, $11,000, which would be on the tax return but not on our income statement because it hasn't been earned yet. So another thing that would be different. And then we have our depreciation continuing from 2015, and we have a new asset for 2016 where we take the whole cost of the asset all at once. That's what Section 179 means. And then the depreciation calculated using the cost divided by 5 divided by 2. So if you keep a little running total over here, to the side here, we have our book accumulated depreciation. This is total for last year and this year for the 2015 equipment and the 2016 equipment. All right, so we've done a year and a half of depreciation on this and just a half a year of this. On the tax return, we've taken all of the depreciation from last year plus makers for 2 years, and then here is the tax depreciation on the new equipment, all of it in 1 year. So we look at the cumulative difference between the two. 29 for 2015 equipment and 2016 equipment is 64, 67. Add those together, and that's your total accumulated depreciation difference to date. Accumulated. Remember that accumulates from one year to the next. So, coming back over here to our our process, we end up with our income, taxable income on the tax return, and the before tax income on the income statement. All right, so looking at the current tax expense, we take our taxable income multiplied by the tax rate, just like we did before. We look at our various differences. Let's start with the unearned revenue, do them in the same order we're doing them here. Oh wait, let's do it. A different order. Yeah, all right. We will do the deferred tax asset for the bad debts first. A little bit out of order here. We take the bad debts. The allowance is the cumulative amount of the bad debts have been different. Okay, we started with an allowance of $8,500. It's now up to $25,200. We multiply that by the tax rate, and then we compare it to the deferred tax asset that we already have from last year. Okay, so we find our amount and then we compare it to last year. All right. Our liability, looking at the depreciations together, we notice that our cumulative difference in our depreciation is $35,963. We multiply that by the tax rate, and that gets you $12,587. But remember, we already had a deferred tax liability of $10,763 from last year. So we only need to increase it up to the 12. So we only need to credit it $1,824. So that was, here's the depreciation, deferred tax liability journal entry, the bad debts, and then finally the new one, the unearned revenue, 11,000 multiplied by the tax rate. There's no, obviously that's the cumulative difference, and there's no existing tax asset for that, so we don't have to compare it to last year at all. We just make the journal entry for the whole amount. So, tax expense is current is 95 from up here in this journal entry. The deferred is the sum. In this case, you actually have two credits and a debit. So you actually have a credit to deferred tax expense. So that's subtracted. Total tax expense is $88,006. Bring that over here to calculate net income. Income before taxes, tax expense, net income. Effective tax rate, again, do a rate reconciliation, is 33%, just like last time. We get the 88 divided by 262. These are rounded, so it doesn't work out exactly right. You got the municipal interest going one way, you got the life insurance going the other way, to get up to 35% that our tax expense would be if we were actually recording it at the statutory rate. So because of these permanent differences, we saved about about $4,000 between what we paid and what the effective rate was. So that's the way to do it if you have the information side by side in that regard. So